Why do you think we see banks tightening lending standards even as demand for loans fall?
This is super interesting. What we are seeing right now is that although central banks are injecting trillions of liquidity and lowering rates, that it's becoming more and more difficult to get a loan because credit standards are being tightened dramatically. And the reason for it is that banks cannot loosen credit standards at the same time as what we're seeing, a very large increase in non-performing loans, credit card delinquencies, etc. So in a perverse way, what we're seeing is that the central banks are drowning the economy in a sea of liquidity. That massive liquidity is going to financial assets, and it's not reaching the real economy, mostly because it could not reach the real economy in an environment in which the solvency ratios and the ability of businesses and households to take more credit is actually worsening.
And of course, the Fed is very much encouraging lending. It's encouraging lending, but will this reluctance to lend on the bank side, will this affect the Fed's plans?
I don't think it's going to affect the Fed's plans, but the Fed needs to understand that you cannot take a horse to water and force it to drink, that the economy is not demanding more credit because this is not a problem of demand for new credit. This is a problem of solvency, what we're seeing right now. What we're seeing is that many businesses simply don't have the sales to continue working, that many households are suffering because of unemployment. So it's not making it easier for these businesses and households to take more credit what is going to solve the economy. What we need to do is to put together an important package of measures directed towards the creation of new businesses, directed towards the improvement of the economy and the recovery of the services sector. It is not going to come from more liquidity. Unfortunately, I believe that the Federal Reserve will continue to pump money into the economy, will continue its very aggressive easing policy with very low rates, but it cannot address, to start with, and it does not address the problem of solvency. You don't solve a problem of solvency with more liquidity.
And very quickly, Daniel, of all the countries around the world, at least one of the worst hit is Spain, even worse hit than Italy from a GDP perspective. Why is that exactly?
There are many reasons. On one side, Spain has been very poor at addressing the pandemic effects with supply-side measures. The government refused to lower taxes and was very reluctant to introduce measures to help SMEs, small and medium enterprises, and households. The government believed that this was going to be a very short crisis, and that the economy would rebound very quickly and bounce back very rapidly, and it's not happening. The other problem is that the crisis is affecting all of the areas of the economy that could actually help in the current situation. Exports are down almost 33% in the quarter. The services sector is badly hit. Obviously, tourism is very important in the Spanish economy, but there are other elements that are being negatively affected. The government constantly and consistently talks about raising taxes, so that is obviously discouraging businesses from hiring and from investing further.
Daniel, I appreciate your insights as always. Thanks so much.
Thank you very much.